Thank you for joining us today on the Dollars and Sense Podcast. If you're listening to the Dollars and Sense Podcast for the first time, it's a show where we get people to discuss some of the most interesting finance topics. Today, we are at the FSM InvestExpo 2025. This is an annual event organized by FSM and it's usually the first investment event that we have each year in Singapore. And for this year's theme for the FSM InvestExpo is Seize the Future, Supercharge Your Portfolio. And when we're talking about our future in 2025, I cannot think of a more important theme for the year than Donald Trump 2.0. Yes, if you don't already know, Donald Trump is back and his resounding victory in the US presidential election has left investors across the globe scrambling to assess what his return to the White House will mean. Will there be a global trade war again, and how will this affect companies? So for our topic today is Donald Trump 2.0. What should Singapore investors be worried about? And joining me today to discuss this topic is You Weiren, who is the Senior Portfolio Manager, Research and Portfolio Management at iFAST Singapore. Weiren, welcome to the show.
Thank you for having me today.
Well, there's really no two ways to put it, right? Donald Trump is a divisive leader, and in the US, it's sometimes feel that people either love him or hate him. When it comes to the financial markets, however, it seems that the market is actually pretty receptive to him and his policies, or what he hopes his policy will achieve. And also, this is the second term as president. So it's unlike his first term where you could say there's an element of uncertainty around how he would govern and what his policies would do. By now, the market, businesses and investors should already have time to evaluate his leadership style, the impact of his decision, and the potential direction of his administration. So Weiren, I just want to ask you, let's start with the big picture. The general sentiments among investors regarding Donald Trump being elected as president again is quite unlike what you see on social media, where people are generally discouraged or a little bit disappointed on his election victory. But rather, when you look at the stock market, you could actually see that the market genuinely look like it favors his leadership. Or is it just a reaction to the market that they are already expecting the victory in the first place?
Well, actually, if I look at the markets in general, and that includes the stock and fixed income market, I think the reaction to Donald Trump's re-election is actually, I think it's a bit of a mixed reaction. If you ask stock market investors, I think like you have said, judging from the very good performance of equity markets after his re-election, I think investors in general are quite happy with the outcome. But if you ask, fixed income investors, I think the reaction is a bit more muted. The enthusiasm is not as strong as equity market investors. And simply because different investors, they have different things to worry about. Crypto investors, of course, are over the moon at this point, following Donald Trump's re-election. For stock investors, I think they are generally quite positive on the outcome, not because they have always been favoring his leadership, but rather I think it's just a very clear-cut victory for Donald Trump, which sort of removes any source of uncertainty surrounding equity markets. And I think before the election, I think there was some speculation that if Donald Trump doesn't win the election, he's going to contest it and he's going to do, some radical things that he probably will do. But that didn't happen because he has won, and he has won by quite a wide margin. So that is a clear-cut victory. It removes any source of uncertainty. And also the tax cut plans that he has proposed, I think that is also something that our stock market have cheered. But over in fixed income markets, I think the concerns are a little bit different because for fixed income markets, they care about inflation. And they care particularly about his tariff plans, which are inflationary in nature, especially if the worst of his tariff has materialized. And then there's also the mass deportation plans. If there's going to be a tighter labor market, that is going to be inflationary as well. Widening deficit, that's also likely going to happen under the leadership of Donald Trump. So I think different investors are worried about different things. And I think Donald Trump in general is quite unpredictable. He's not compulsively unpredictable. I think he's intentionally unpredictable because I think he's a negotiator at heart. He likes to extract maximum concessions from his partners. So that's who he is. And as a tough negotiator, you don't really want to show your hand. So I think his unpredictability is also one of the reasons why different investors perhaps have different reaction and sentiment towards the outcome of the presidential election.
Yeah, I think one of the things which certainly is a hallmark of Trump's first term was really the geopolitical tensions he introduced to the world. particularly the US-China trade war. And I think some analysts, or at least this is how I look at it, some analysts believe that his approach, his protectionist approach, kind of favor US stocks or US companies. But what are your thoughts on this? And I just want to also ask, like, are there clear winners and losers if Trump moves forward with his proposed tariff threat?
I would firstly respectfully disagree with some of the analysts. They are saying that protectionist measures are good for the U.S. economy. I don't think so, because my personal view on tariffs is that it is actually a lose-lose proposition. Because if you look at history, countries that are open to international trade, so these are usually the countries that they tend to grow faster, they tend to innovate faster, and they also tend to have higher productivity as well. So to say that protectionist measures benefit the U.S. economy, I don't think that's true. In fact, I think having an open economy is good because you are inviting foreign competition to compete with domestic investors. So I think the biggest losers from Trump's policies are really those countries that have the highest trade surpluses with the US, because Donald Trump is, he's super focused on trade surpluses. He believes that countries with trade surpluses with the US are ripping the US off. So I think he's going to concentrate on that.
So China, essentially.
China, definitely one of them. And but for China, even though I think is one of those losers, but China, it is actually not super dependent on international trade. Its economy is driven more by its domestic consumption, which also means that China, it has other issues to worry about than Donald Trump's tariffs, because I think China's problem right now is a confidence crisis at home. And China is also struggling to revive its economy. So I think that is their main issue to worry about rather than Trump's tariffs. The countries that need to worry about Trump's tariffs is actually European countries, because Europe, not only is it highly exposed to international trade, it also has a lot of trade links with the US. So if the US were to have tariffs on European imports, then I think that's going to have a major impact on Europe. And Europe is also waging a trade war with China with the imposition of tariffs on Chinese EVs. So it is waging trade wars on multiple fronts, and I don't think it is something that European countries in general can afford to have. And another country that I think will have a huge negative impact from all these tariffs is actually Mexico.
Right.
Mexico has jarring trade surpluses with the US, and it's not just about the tariffs. For Mexico, another concern is the mass deportations, because if there's going to be a mass deportation, a lot of these immigrants, they're going to go back to Mexico. And I don't think Mexico's labor market is able to absorb all these people all at the same time. And I think for Mexico, remittances is a key source of income for this economy. So if all these things disappear overnight with mass deportation, then I think Mexico's economy is going to take a major hit. China, not so much because of its less dependency on international trade, but it has other issues to worry about. So I think what this means, with Trump coming back and taking a more hardline approach on his trade policies, I think what we are likely going to see is a further acceleration in the relocation of supply chains out of China. Because when it comes to China, it's bipartisan. The rise of China and encountering China is something that both Democrats and Republicans can both agree upon, which means that, even with Trump coming in, as president, it's not going to change the overall stance towards China. In fact, it's going to harden. And what that means is you're likely going to see, an acceleration in a trend that has always been ongoing, which is a shift of supply chains outside of China. And for those businesses that want to still do business with China, they will probably have no choice but to maintain two different supply chains, one to cater to the Chinese market, and the other one to cater to the rest of the world.
Yeah. And I just want to ask a follow-up question to that, which is, besides Europe, what about other countries in Asia, for example? I think Japan could be a market which a lot of people were looking at in 2024. How would that impact maybe the Japanese market, or maybe even back at home in Singapore? Do we need to be concerned?
I think if you just look at the potential relocation of supplies outside of China, these supply chains, they have to move elsewhere. So one of the key beneficiaries from this relocation is actually countries like Japan, countries like South Korea, because of their advanced manufacturing capabilities. So these two economies, they will be able to benefit because of that. And then we also have Singapore and Malaysia, which could also potentially benefit as well. And I think Singapore in particular will be able to benefit from a further decoupling of US and China, simply because Singapore, we are a global financial hub, and which also means that we will be able to benefit from an influx of regional wealth. And our status as a regional financial hub has also been enhanced by some of the recent political uncertainties that have taken place in Hong Kong. And of course in Switzerland as well, the collapse of Credit Suisse, I think that has dealt some damage to investor confidence as well. So that has, all these things have happened concurrently to enhance the appeal of Singapore as a global financial hub. So I think Singapore is going to be one of those beneficiaries as well. In terms of risks, I'm not saying that there are absolutely no risks for the other Asian markets. The neutral countries like Singapore that have been playing both sides of the US and China divide, I think there could come a point where, neutral countries like us, we probably have to pick one side over the other, especially now with Trump coming back, because I think Donald Trump, in the past, he has put countries in a difficult position of having to choose between the US or China. If you want to do business with the US, then you will have to stop, your business dealings with China. So that's something that he has been telling his partners last time. And now that he's back in charge with a more hardline foreign policy, he probably will do that again. And Singapore, being a neutral party, I think we will probably suffer if we really have to choose between one of them, because we will have to forego, the benefits and also the economic ties of, being associated with one superpower.
I think basically that goes back to your point where, if there's a trade war, there is really a lose-lose outcome.
It is.
Not just for the countries involved, but also for the neighboring countries or the countries that are involved in doing business with maybe both of this big economy. And I just want to ask, in looking ahead in 2025, I know you presented just about 20 minutes ago about the US. And you talk about some specific sectors or industries that might be interesting to look at. Mind sharing that?
So for 2025, our view and our key recommendations is actually for investors to invest into the semiconductor industry and the digital economy, because these are sectors that benefit from long-term structural trends. And interestingly, even though 2024 was a year of elections and a lot of people are focused on the impact of Trump's policies, our investment thesis for these two sectors actually has nothing to do with
elections, right? Yeah.
It doesn't, because our view is that the US has several unique strengths that puts it in a good position to continue maintaining its dominance over the world, and also to maintain its stock market performance. One of which is, of course, its stock market. The highest and the best quality companies, they are actually listed in the US, and the US being an attractive capital markets for businesses and high growth startups to raise capital, it is going to foster an environment that that's centered on innovation, which also means that the US is certainly going to continue maintaining its lead in global innovation, and US companies are likely going to be the key beneficiaries of long-term structural mega trend, which is already happening. So our investment thesis is not so much about Donald Trump, but rather the long-term structural trends that are taking place in the world, and how the US companies, they are going to be in the driver's seat of it. They are going to be the ones who are going to determine the rules of any new technology that's going to come out. Their earnings is also going to be going to benefit from this as well. I think if you look at S&P 500 performance in the past, I think it doesn't matter which president is in charge. Throughout both Democratic and Republican presidencies, the S&P 500 has continued to do well. Innovation has also continued, and this is why we are still positive on the outlook of the US equity market, even though Donald Trump is back, and even though he brings with it greater uncertainty for not just the global economy, but for the US as well. And it is for these reasons we encourage investors to focus on the long term, focus on fundamentals, focus on earnings of US companies, which at this point I think it looks fairly optimistic.
President Trump has always presented himself as a pro-business person who prefers lower interest rate naturally. Yet at the same time, some of his policies or some of his attitude towards, policies like tariffs are contradictory, because tariffs will inevitably increase inflation,
yes.
And the increase in inflation will then likely lead the US Federal Reserve to kind of think about, not reducing interest rates so quickly, because they want to keep inflation in check. So the Federal Reserve Chairman Jerome Powell actually said likened this to navigating a foggy night. And he says it's kind of like common sense that when you think the path is uncertain, you go a little bit slower because obviously you can't see the road as clear. How do you interpret this tension between Trump's preference and desire and the Federal Reserve having some hesitation naturally?
I think tensions between central banks and government is actually not a new thing. So right now, central banks across the world, they are mostly tightening at a time when governments are loosening their purse strings and increasing their government spending. So there's this tension. But it's nothing new because in the past, it was actually the other way around because, after the global financial crisis, governments were actually not too willing to spend because they were more focused on, the sustainability of their government debt after the financial crisis. So they were not too willing to spend. And the only game in town when it comes to stimulating economic growth was actually monetary policy, which is why I think for the past decade, when it comes to reviving economies, it has always been central banks, holding the news headlines. It's always about cutting rates, and which is why we have an era of easy monetary policy. I actually think it's a healthy thing because it just means that the Fed is an independent entity, and that the Fed is making decisions not based on political considerations. It is making its decisions and policies based on economic grounds. So that, to me, I think it's a positive thing. And it also sort of acts as a kind of a checks and balance on government spending, because if there are higher interest rates, it's actually supposed to help promote fiscal discipline. If the government wants to keep borrowing at a time where interest rates are high, then you will have to counteract this effect by either raising taxes or cutting spending to make sure that your debt levels are sustainable.
So my final question is really from a portfolio construction perspective. That's the uncertainty for President Trump's return makes it even more crucial for investors, especially Singapore investors, to maintain a well-diversified portfolio across different regions, right? And my thoughts are that because it's divisive, there could be economies that do well or worse, do badly because of his policies, and hence you don't want to be like 100% all into, say, China's market. What do you think about that?
My opinion is actually more of an unpopular opinion. I actually think there is no need for investors to diversify, especially if they don't have a conviction in the underlying markets that they want to diversify into, because diversification is meant to lower your overall portfolio risk. But if you don't know anything about the market that you want to invest into, you could end up introducing more risks into your portfolio instead. And at this point, I think there's also very little justification for investors to do diversification, especially for investors that have already been investing heavily in the US equity market.
Okay, so when you say there's no need for them to unnecessarily diversify, you are referring to the fact that if they are already 100% into the US market, they should be safe.
Yes, that's right. I don't think there is a need for them to further diversify into other markets because there is little justification. Because, right now, the US stock market, the US economy, they are outperforming and they are also in a position to outperform the rest of the world. So it is very difficult to justify, or rather it's very difficult for me to advise other people to diversify outside of their current US holdings. And also for US investors, 100% in US equities, I know it looks a bit concentrated,
it does.
But your portfolio is actually more diversified than it looks because a lot of these US companies, they are MNCs.
Global companies.
Yeah, they are global companies. They derive revenue sources from overseas markets as well. And if you just look at the S&P 500, I think the split of revenue sources between US and non-US sources, I think it is in the area of around 60-40, if I can recall. So your portfolio, even though it's 100% into US equities, it's actually fairly diversified into other global markets. I think there is some value in diversifying their portfolio holdings into the US, for example. And I think also another economy that's worth considering diversifying into is Japan. We think it's undergoing a structural transformation in its economy.
Right. Thank you, Weiren, for sharing your thoughts with us on the Dollars and Cents podcast.
Thank you for having me as well.
Yeah, and if you are listening or watching this episode online, we hope this has been useful for us. If you like our content, don't forget, as usual, to subscribe to us, whether you're watching this on YouTube or listening to this on Spotify. Leave us your comments on your thoughts on this topic. We'd love to hear from you. Thank you.